All right, we are recording. Those of you who have already joined us, we're just going to give a minute courtesy for people who are wandering in. We have our guests here and looking forward to a really good session. This was a fun topic to talk to them about. It's something I think that there's been a growing interest in, and we're going to have some fun with it. So I think we'll get going. I'd like to welcome everyone to this week's edition of the Camel Plan webinar, where we're going to take a look at picking new tech and venture winners. Self-directed investors have been hunting for greater returns, who are hunting for greater returns, are becoming increasingly interested in venture investing, where the multiples on equity participation can be vastly larger than those of other alternative asset classes. We're seeing a lot of interest in this area, but where to start, right? You get into AI, onshoring, offshoring, and reshoring, supply chain and logistics, which is being reconfigured in the wake of COVID, fintech, medtech, prop tech, which is a real estate term that we've become familiar with over the past few years, are trying to pick the next pre-IPO NVIDIA. Well, today we're going to look at an area where you might not think to find disruptive technologies and nimble organizations, but that's part of what makes what we're going to talk about today so promising. First, let's get to the housekeeping. As you see up above me, but right next to you, there is a disclaimer. We are a neutral third party. We're custodians. We can't recommend by law or endorse or promote any investment. So we always ask you to seek out the advice of your tax preparation specialist, your attorney, your CPA, and don't do anything without appropriate guidance. So, Rob, while I'm doing the introductions, I'm going to dive off here and quit sharing and go ahead and get your let's get yours put up there.
All righty. Hi, everybody.
All right.
Let's make sure everyone sees the deck.
Yes.
Yep, it's visible.
All right, we're good.
Good. Yep.
All right. Okay. Let me just close this window here. All right, I can see it. Let's get to the meat of this. Today, we'd like to welcome Rob Panapinto, Managing Partner, and Brian D'Ambrosio, General Partner of Govo Venture Partners in Winter Park, Florida, and Christian Voss, Founder and Managing Partner of Bedford Capital Group, who's based in Bedford, New York. Rob, we got the screen swapped out, so I think we're ready to go, and I'm going to make some introductions, but I'm going to urge everyone to read the bios because these guys are involved in a lot of stuff. They've got a lot of things going on, all of it pertinent to their experience and the chops that they bring to this session. Rob Panapinto spent 25 years scaling high growth companies as an executive operator and investor. He's CEO of Entrepreneurs in Action, a venture fund focused on early stage social impact companies. And he's highly involved in supporting the Central Florida venture ecosystem through his work with the University of Central Florida Innovation Districts and the Orlando Economic Partnership, among other organizations. In 2023, he was appointed by Florida Governor DeSantis to the board of the Florida Development Finance Corporation. Brian D'Ambrosio has 2 decades of experience with direct investment advisory, due diligence, strategy, and business development, much of it in the healthcare innovation and healthcare technology commercialization space. He currently serves as managing director at North Star and as VP of strategy and business development at Northwell Health in New York. That's New York's largest integrated health system. Prior to this, he spent 12 years in alternative asset management, most recently as principal and director of research for Arrow Capital Management. And rounding out the guest list is Christian Voss, who brings 25 years of international investment banking experience to the table, beginning with private capital markets advisory for Merrill in New York, London, and Hong Kong. At Bedford, he's responsible for private financing and capital raising advisory for middle market direct and fund clients in North America. Prior to founding Bedford Capital, Christian served as managing director for investment banking at Knight Capital Group and headed the global private debt team at BNP Paribas Securities in New York and London. And Christian, I think you wanted to mention a couple of other things about Bedford.
Thank you, Joe. It is a pleasure to meet everybody here today on the call on the Zoom. Bedford, through its parent firm, IIB, is a registered broker-dealer in the U.S. Via FINRA and the SIPC with 75 professionals. We are charged with assisting the management team of Govo Ventures to raise capital for its fund, and it's a pleasure to meet everybody.
Thanks, Christian. There's one other member of the team who is not here today but will be discussed. And those of you who registered early in the process probably didn't see the announcement we added to the registration page. So we'll talk about that during the course of the presentation. Welcome to all three of you. As we can see, you guys are pretty busy, so we appreciate time that you've taken to visit with us today. Those of you attending, please feel free to type questions into the chat Q&A box. We'll answer them if they, as they are relevant to what's being spoken about at the time, or we'll save them to the end. So without further ado, Rob, I believe you're taking the lead on this. So
Yeah, thank you, Joe, and I do appreciate everyone's time, especially I know it's a holiday week. There's actually two folks that are not here today. Yes, Joe's alluding to one that's maybe got a little more celebrity cachet. We'll talk about him in a minute. But the other is also one of our other partners, Jonathan Kilman, who's important part of what we do, and I'll talk about him a little bit as we go into the presentation. And as Joe said, yeah, I know everyone was on mute, but feel free to send chats as we happen. I'm totally fine. Brian and I are fine with you guys, stopping us, and it won't throw us off. And we're happy to answer the question at the moment. This is sort of my disclaimer, slide. Obviously, this is a private placement for individual accredited investors or accredited investors. And I agree with Joe's comment that you should obviously, seek your own tax and financial advice. So I'm going to sort of kind of just talk a little bit about Govo for a second so you understand what we do. And then I'm going to maybe back up and talk about the venture market in general so you sort of understand the macro environment that we're playing in and interestingly why we think, regardless even of our specific niche, why it's a good time to be in venture. But specifically with regards to Govo, so we invest in companies that early stage companies, which for us means seed, which is probably their first professional round, post revenue. So they're generating revenue, they've got a team, but it's probably the first time they've gone beyond friends and family capital. And then we'll go on and do follow on through Series A, which is where you tend to get larger funds and larger venture funds. And then after that, we'll start to exit and then hopefully return capital back to our investors. The companies either need to be in a highly regulated industry by government or selling directly to the government. And again, I'll walk you through our thoughts around that and our expertise in that space. But that's the world that we sit in. But I wanted to talk a little bit about the venture market just in general. Hopefully the slides are moving. They're moving, I assume.
Yeah, you're good.
They are.
Good. All right. Yeah. So it's kind of an interesting time, right? Because as you look at some of the challenges that have happened with interest rates climbing and making it harder to raise capital in different investment classes, well, the other side of it is it means it ultimately makes it a good time to invest, right? Because when capital is scarce, then valuations tend to drop, right? And there are less players chasing, from a finance side, certain deals. So if you look at this chart, you really see what happened in 19, 20, particularly 21 and 22. The number of rounds, the size of rounds in this case, it's seed stage we're looking at, went to an all-time high and then just continued and just came down in 2023. And to some extent have leveled off in 2024. For a fund like ours that closed in 2022, that's a great tailwind for us. We have no legacy portfolio companies that we bought at a high price that we're now trying to figure out a way to exit. And and we're getting companies at a very strong valuation discount. And if not necessarily even a valuation discount, the ability to negotiate very strong terms and protective rights, which are very important in early stage investing. And I'll talk a little bit more about that as we get into how we approach investment. So you've got a lot of people who are involved in this space. Any of you guys who listen to the All In podcast, Jason Calacanis is, one of the four besties and really the most early stage venture guy. And he repeatedly talks about it being just an amazing time for seed stage investors. You hear a lot about vintages. I expect 2023 and 2024 will go down as very strong vintages for early stage investing. And obviously that's where all of our investments will be for, certainly at the early stage of our launch. Again, more data at this, right? Pre-seed and seed deals, 13-quarter low. Valuations, again, they've sort of hung in there, but certainly lower than what they were the prior 2 years. So again, more slides that just indicate it's a really good time to be in venture. The buy low, sell high phenomenon from a macro basis will probably apply to this vintage. We certainly think we have some advantages because of what we're doing in the market. But if you just look at the macro, when you invest in companies in 2022, 2023, 2024, you're looking at 5-year cycles before you exit. Most likely, we're going to be in a lower interest rate environment at that point. We'll probably be in a different market upswing where valuations will be on the other side. We certainly expect, whether it's us or any other venture investing you're doing, you should see some macro trends heading in that direction. I don't know if this is going to play. We're going to try it. It came from a LinkedIn post. And it was really just a wonderful graphical representation of the change in multiples. So it looks like it is playing. So it's going to go back to 2020, and you just look at what the revenue multiples were for companies at various times, right? And you see in 2020, it really start to climb, really get higher in 2022. And multiples now 20, 30 times sales for early stage companies. Continuing throughout 2021. And watch what starts to happen here now. Boom. I mean, they just drop off a cliff. That's the environment that we are investing in. And again, outside of all the things I think we'll say that we think are advantages to how we're approaching investing, I think indicate just the power of being in this marketplace right now. Go back to my deck.
Is it okay if
Yeah.
if you can, from that end, maybe drop that link into the chat? Are you able to do that? I don't want to interrupt your cadence.
Yeah.
You can't. We'll do it at the end. Don't worry about it.
I will try. I'll try when we get out of it, when we're done, but I will try to put it in. Or I'll send it to you, Joe, but I will try.
That's fine. So you're saying conditions are good right now, and they're likely to stay that way for the near term.
Yes, and I think it also bodes well for the trajectory of when you would start to see exits, right? Because at some point the market will change, and then you get that updraft back. So I think we're catching the macro trend at the right time.
Okay.
So again, we are investing in companies that are in regulated industries or selling to government. And I'll give you a little bit of the background of how we got to this point. Joe gave you a little bit of my background. So I spent close to 20 years helping start, build, and then scale a healthcare technology company. And it's sort of come full circle. I didn't necessarily recognize it at the time, but I can point to both our private equity recap in 2006 and the sale of our company to a public entity to changes in federal government regulation with regards to healthcare. We needed private equity capital because the Bush administration created Medicare Part D, and we went from 25 million to 80 million in literally 16 months and just needed more capital. We sold the company because Obama was president and was talking about Obamacare, and one of our biggest clients said, "We see what's coming. We need this company," and a public company bought us lock, stock, and barrel. Healthcare is a highly regulated industry to begin with, but you really see the change when you have this macro trend. So it was always on my mind. And after I left the company a couple of years after that, as Joe said, I really sunk my teeth into helping other entrepreneurs grow and scale as a private investor and starting these accelerators. and really got involved in the economic development expansion of the state of Florida from an early stage perspective. Then Joe didn't mention this. I ended up actually running for office. I ran for county mayor here locally.
I was going to do that.
Uh,
I didn't know if anybody would hold
it's
it against
okay.
you, though.
It's fine. It's depending upon people's perspective. It's a wow, that's great, or what, were you crazy? So it's either or. But what it's always meant for me is I've increasingly been at the center of where government, innovation, and investment have come together. And I will tell you, this is not necessarily a good thing, but just the mere fact of running for office, you kind of become part of the club. And you start to understand, again, I think it's probably unfortunate, the importance of the club and really understanding it, particularly for these early stage companies. And so along that journey, I mentioned one of my other partners, Jonathan Kilman is Brian and I's other main partner. And Jonathan is a lawyer and a government affairs lobbyist and communications executive by background. He'd worked for Governor Bush in Florida and Governor Christ. And he was the head lobbyist for many years for Foley and Lardner, which is a national law firm. And he and I met doing some economic development work together. And his work had always been lobbying for innovative technology companies. He had helped write a lot of the early ride-sharing legislation as Uber and Lyft were expanding nationally, a lot of telemedicine legislation, a lot of work for autonomous vehicles. And Jonathan and I actually ran a business together during COVID where we were helping early stage technology companies get to market. And in that case, government was often the buyer. And in some cases, we were dealing with the EPA from a regulatory standpoint. So this theme of innovation and business and the challenges of early stage companies trying to navigate that and compete against the bigger boys really came up. And for Jonathan, I also said, it's interesting from a monetization standpoint, you get paid really well, but you're unlocking enormous value for these companies that you just don't touch in that model. And so that led to some conversations about what ultimately became Govo. And at the same time, you heard Brian's background before. Jonathan and Brian were working on some really interesting healthcare things together and helping some early stage healthcare companies grow. And Jonathan said, "Hey, if we're going to do this, let's include Brian. Let's bring Brian into this. He's got a great institutional finance background." And that became the crux of the foundation of Govo. And at the same time, we recognize from a macro standpoint, and Joe, I think this may be one of the questions you've asked us about in the past is, government's role in innovation. And again, I don't say that this is a good thing or a bad thing. It just is. Increasingly, government is at all levels is playing an increasing role in terms of innovation. And a lot of it came out of COVID. I think COVID revealed just how antiquated the technology that different levels of government use and how it needed to be modernized. The Florida unemployment system crashed within 3 days of the PPP program being launched. They just couldn't handle it, right? And we all know the story of how long it took the White House to create a website to send us test kits when Amazon could have done it in 45 minutes. And you also saw both in the Trump and the Biden administration a lot of money being pushed down to the states around industries that they liked or disliked. Right? Sometimes government's a headwind. Sometimes it's a tailwind. You're seeing a lot of conversations now about AI. Government at all levels will regulate AI. The question is how they do it, what they do with it. And so for us, with the expertise and the experience we bring to the table, we recognize that there was a unique opportunity with these early stage companies to provide them not just with capital, but with guidance that would help them grow and scale, which in the context of a fund, hopefully means that we'll be able to generate really strong returns for our investors. Interestingly, too, if you overlay our thesis with the innovation industries in the state of Florida, where Jonathan and I in particular have just really unique connectivity. Most of our LPs from Florida, so we just have a really tight grip on what's happening from an innovation standpoint in this state. And Florida is a wonderfully, from a venture standpoint, underserved market, not a lot of funds. It's a great state to invest in. There was a lot of match there too. So that was really the history and premise of why we launched Govo. Closed it, as I said earlier, at the end of 2022, and I'll sort of share now what we've done over the last 18 months since then. Real quickly, big industries here, and again, argue whether it's right or wrong, but Healthcare and fintech and things like insurtech have always been the case, but there's an emerging privatization of the space program, which is happening here, not too far from where I live in Central Florida. But aerospace, ed tech, transportation, climate tech, right? The current administration is heavily pushing green energy and climate-friendly technologies, cybersecurity. All of these have the thumbprint of government on it in one way or form that entrepreneurs have to figure out how to navigate if they're going to scale and compete against some much larger entities. No surprise here, government is a big, a very big customer. This is data that's actually a couple of years old. And I think government will continue to be a large customer. And again, not just in defense, but across broad swaths of technology. I already mentioned our focus on Florida. So again, we've been at this for 18 months, and this is the missing partner that Joe alluded to before. So I'm going to guess everyone on this call knows Tim Tebow. We're really excited to add Tim. We met with him in his family office about 8 months ago, and Tim, first of all, I think he's forget about his athletic prowess and what he's done there. Just as the career he's built, the integrity that he has. It took us 8 months to finalize an agreement with him because he was doing extensive due diligence on us, right? Just to make sure that we were the type of people that he wanted to associate with. And, fortunately and proudly, we are. But he is one of these unique people in this environment who has the ability to take some pretty strong stands on things. He's very, very vocal about human trafficking and human slavery, but he's also got a very strong faith-based focus to his initiatives, cares very much about people, and yet seems to be has the ability to kind of cross the political chasm, which for us, given how we invest, is really important to us. So what's exciting is too, he's really not just a face. So he's not just a celebrity face. He has a great family office run by a guy who's an experienced healthcare entrepreneur with a venture background who's joining our strategic advisory board. And Tim just has access to networks in terms of interesting companies, his ability to grow our portfolio companies. Yes, certainly in terms of some fundraising as we close out our fund, but we're really excited to bring Tim on because he's very mission focused in supporting entrepreneurs who are doing big things. And while we're not an impact fund per se, by playing in regulated industries, to some extent, we are working with companies that exist because the government or nonprofits can't solve a certain problem. And so the entrepreneurial community and the business community needs to solve them. So it dovetails very well with where Tim wants to drive. And so we're proud to be his partner. He's also, obviously a proud Floridian. The fact that 5 of our first 7 investments are in Florida was a strong tie. As I mentioned, we've made 7 portfolio companies to date. These are the logos on the side. I'm going to give you a brief summary of them a little bit later. The most important thing I think to understand at this point about these investments, and to me also as someone who's invested as an early stage investor as an individual and also done it as a fund LP and now a fund GP. Really how this is, venture investing is really not necessarily for the faint of heart as an individual, because by its very nature, you're investing in companies, you're taking minority positions, they're likely to raise capital later. As you go on, that capital gets more and more sophisticated, more and more professional. And to be honest, the later stage guys have a somewhat sometimes jaundiced view of what they perceive as individual high net worth angel investors. And they sort of like to swat them away where they can. And they do that with preferential terms that they create. They do that sometimes with early redemption rights where you're bought out of a position that maybe you would like to have stayed in on because there's more growth. And so I sort of, I've had those scars a little bit on my back. So, Brian and I always have this conversation in our investment committee meetings because I think he knows I'm always going to really fight to protect where we, who we are and where we are, even though we're taking minority positions in these companies. So for us, in our thought process, first of all, we look at, can we provide capital and expertise? Like what value can we provide beyond our capital? But basically we like to lead rounds. So because leading rounds means we get to work very closely with the entrepreneur. We set the terms. We're not inheriting the terms that another finance arm or another fund or a family office has set. We think that serves us better. We generally will not invest in a company that we don't have a board seat, and often a board seat that is protected for multiple rounds, or even as while we're still involved in the company, again, to protect us from some of that later stage dilution. In many cases, we also gain advisory shares in addition to our capital, which increase our stake in the company and reside with the fund. So our LPs benefit from that. And then again, we're often getting preferential terms around our pro rata rights, our redemption rights, what can be approved without us. And all of that, I think, is super important from a venture player, whether you invest with us or you do it with another fund or you do it directly. This type of investing is so prone for not really wringing every dollar out of it. And for me as an operator, people that take the most risk should get the most return. So I don't like people coming in later and just sort of taking my return away from me because they think they're more sophisticated capital. So we try to be very, very sophisticated capital at the front end to protect our investments and our LPs, and frankly, to help the companies scale because we think our involvement helps them grow. We also right now are leading the Series A for Resilient Health, which was our first investment. We will not be cashing out, but it is likely a up round for us. So there will be a paper increase likely in the fund coming, which I think is a positive for anyone just 18 months into their journey, particularly in this investment environment. And there are some co-investment opportunities. I don't know if anyone here actually, does any co-investing alongside of funds. And because we're 18 months in, if you think about investing in a venture fund, people go, oh gosh, I'm locking up my money for 10 years. And how far am I away from liquidation? Well, we're already a year and a half in. So, we've got probably another 3.5 years of first investments. And our companies have already matured to the point where we're now on our second rounds of funding. So I would expect that 3 to 5 of these companies, in addition to Resilient, will be raising their next rounds next year. And so we're a little bit closer to when hopefully, we can be sharing distributions back to our LPs that had you been catching us at the very beginning. And, anyone who comes in now gets their pro rata share of all of our investments. A little bit just on the nuts and bolts of the fund. The target fund size was 50 million, and the Bedford guys are working diligently to help us get there in the next few weeks, right, Christian?
Yes.
The return profile Joe mentioned, the opportunity for higher multiple returns. We certainly think, based upon the niche we're in, the macro environment we're in, and also how we're structuring deals, I would hope that we're at the top end of this range, and our IRRs, when you back us off from the time you're investing your capital, should be in the 30s. Obviously, I can't guarantee that. This is early stage investing, but that's certainly what we're targeting, and I think we're trying to set ourselves up for that success. Our minimum investment is generally $250,000, but because we're doing this through Camaplan and we're connecting with all of you in more of one fell swoop, we're certainly open. We're open to having a conversation about accepting contributions that are smaller than that. Probably in the $100,000 range, but our stated minimum is technically $250,000. We do operate on a capital call strategy, so we've only called half of our capital. So anyone who does come in now, whatever commitment you make, you're only giving us half of that capital. We would expect the remaining capital to be called probably 25% in Q4 of 2024, and then the remaining 25% in the following year. We are a standard 2 and 20 format, which means we take 2% for the first 5 years for management fees out of your committed capital. That drops to 1.5 for the back 5 because we'll be doing less investing. You get all of your capital back before we see anything, and then after that, every dollar, 80 cents goes to you, and 20 cents goes back to us. In terms of where we're investing, I think we've walked through this. Ideally, we love to catch folks at that seed stage, so where that first check in average about 500,000. We've done as low as 250, as much as 875,000, but most of them are 500,000 with the ability to go up to, several $1,000,000 as follow on. That's what we're looking to do with Resilient Health right now. More specifically about the term, some of these I've talked about again. First close was December 22. We are going to close the fund. So I will say, there's not a ton of time here just in where we're catching everything. Because we're raising this round for Resilient, technically our round was supposed to close at the end of June, but with Bedford's work and the Tebow announcement, we've created a process that will allow us to take individual investors on for a short window. We can't really extend that through the first week of August because of that Resilient Series A, because we'll have to reprice the fund then, and we don't want to have two share prices for the fund. So we are in a window. We're probably about 35 days out from when we will have to close. We will have to close the fund. As I said, all of the investors will receive their pro rata of our existing, and I've walked through these other things that it's a 10-year fund, but it's really eight and a half years. The last thing that I think is important too, we have, before we actually met the cabinet plan folks, we actually had 3 different LPs who had self-directed IRAs and invested through them. I think they're a great tool because the tax savings there from a capital gain standpoint are so powerful, right? I mean, one of the things that, although some of these companies are mitigated by a federal program where there might not be capital gains, but that certainly won't be the case across all of them. So there's a wonderful benefit here of the capital gain, particularly if you don't need the cash as we're making the distributions. A self-directed IRA is a great way to go, and we've been talking about with the cabinet plan folks about how we build some pretty simple integrations for folks to invest through us. But I think it's I'm glad you guys have them. I think it's a great way to do investments like this.
Thanks for the plug there, Rob. Appreciate that.
You're welcome. So I don't know if you've got anything in the chat, because otherwise I'm going to sort of go through our portfolio.
Yeah, just before we move on,
Yeah.
Okay, so it's a $100K minimum. That is half of the expected capital requirement. There's a capital call. It's a 3 to 5 year time horizon. It's, as you can see right here on the screen, an 80-20 split. Most of you who are listening are familiar with how these funds work. So this is a simple thing to do if you're interested. Thanks, Rob.
I'm going to skip to our portfolio companies real quick. Brian, why don't you chat about our friends at Resilient?
Sure. Thanks, Rob. Good afternoon, everyone. Thank you for joining. So Resilient Healthcare is founded by Dr. Danish Nagda. He's actually based out of St. Louis, and we actually were introduced to him when he was connected with our third partner, Jonathan Kilman, as they were thinking about expanding into the Florida market. This is where I end up spending a lot of my time historically, right in this space. And so what we really liked about the business is a couple things. Dr. Nagda really has a good understanding, and his team, on the primary care market. This is a digitally enabled telehealth and in-person clinic offering. And we really think that fits this area of the market that is now just completely underserved. So on one end, you have incumbent, in-person, fee-for-service based clinics. And on the other hand, you have completely tele models. And each of them have their structural issues. We think Resilient is positioned right down the middle that actually can mix in both in both segments. Starting off selling to employer-based companies, selling them primary care offerings. Next step will be to rolling out his specialty offering, which we think is a great complement to the primary care strategy. And each of those markets, many of those markets are underserved. So the target markets are Missouri, the northern Texas area, and Oklahoma. He had, I think I can say this right, Rob? He had a big win with one of the, yeah, I think so.
I don't know if you're going to say it.
I said, well, the state university that he won, right? I think
that's fine.
Yeah, I think we can say that, right? So he had a huge win with Oklahoma State. And And we think that really is a great target audience for them. So identifying large employer groups, potentially universities, we've been helpful in making a lot of introductions to them. In many markets, the government is the largest employer. And so that really fits in well with our strategy. And we started off, and Rob, I don't know, maybe I could turn it back to you if you want to talk about, the investment, how we got involved, and then ultimately now where we are.
Yeah. Thanks, Brett. So, yeah, so this is the only of our first investments that we actually didn't lead, only because when we closed, they were raising, and so because we sort of came in at the end. But we've over time we've really become their lead investor. We put $500,000 in initially. We had a unique opportunity to put in another $375,000 last September as part of a program with the state of Missouri. Their venture fund was going to invest in the company if they could find a match. And so we've been talking to them for the past 8 or 9 months about leading their Series A, and we agreed to a term sheet about 2 weeks ago. The valuation, as you see here, if you look at the slide, the safe that we invested in has a 29.5 post money cap. The post money cap here, the post money valuation, should this Series A close, is in the high 40s. So this will be a paper up round for us. A board will finally be established. We will lead the board. Again, another one where we've actually protected our board seats until we're exited from the company, because they're likely to have to raise capital again next year. They grew 5x year over year. They're going to start this year at 7 million. So we think we're getting them at a fair and reasonable valuation, particularly if they hit their 2026 numbers. So it's a great company, and we're excited to be partnered with them. And I think we're taking advantage of perhaps some other market dynamics where people don't want to lead, but they'll wait and they'll follow. And, we'd rather go in there, set terms. I think the entrepreneur was hoping for something probably about $10 million higher than that. But, we certainly want to help the company grow, but also take advantage of the environment. So we're obviously excited about Resilient. Our second investment is a company based in Jacksonville. It's a GovTech called Urban SDK. Another one where we kind of came in a different environment. They might have gone to Series A, but they couldn't just because of the market. They had doubled the size of the company year over year, but found themselves really having to raise an extended seed bridge round, which technically was a down round despite their growth. They've now grown. We invested in them about a little more than a year ago. They've now doubled the size of the company again, growing really well. They basically help local and state governments access real-time visibility to traffic patterns, congestion, infrastructure, so they can make much quicker decisions around where to put a red light, where to put a speed bump, where they need to expand a lane, rather than having some guy or gal stand on a corner with binoculars and a clicker all day long. They can use camera data, cell phone data, other internet data, and some proprietary AI algorithms they've built to be able to make it much easier for a local government, much more efficient for a local government to be able to make these decisions. Third company is a really interesting one. It's a Miami-based climate tech called Kind Designs, run by a really powerhouse woman, female CEO. If you look them on social media, they are super active on social media. There's also our other celebrity investment tie. Mark Cuban's family office is a co-investor with us on this one. We led the round along with a family office and the state of Florida venture fund. And what these guys do is they have found a way to 3D print non-toxic concrete seawalls that have undulations on them that allow for plant life to grow and attract fish. So you create artificial reefs with their living seawalls, as opposed to the way it works right now is the state of Florida and all coastal communities are deathly afraid and concerned, legitimately so, about ocean rise. But if you dump just a slab of steel or concrete into the ground, you may be solving one environmental issue, but you're causing another, right? You're just wiping out any of the marine and plant life that's there. Kind has figured out a way to be able to offset that at basically the same cost as a standard concrete seawall. So we're really excited about the growth prospects for these folks. They'll probably go to Series A next year. They're growing throughout the state of Florida right now, and we're talking to them about some national and international expansions. But also just a fun one to follow on social media, by the way. VoxEQ is an AI company in the voice space, leveraging IP that came out of Carnegie Mellon, and a venture studio in Pittsburgh that specializes in helping to commercialize IP coming out of Carnegie Mellon, although they've headquartered the company in Jacksonville. Basically, without a voice print or without having my voice on file, if Vox could analyze my voice and take a really strong estimate in my age, my ethnicity, my height, my weight, to some extent what I look like. Some of it gets a little bit scary, actually. But what they're using it for out of the block is as an early flag for identity theft and fraud at financial call centers. So it's not going to automatically say it's fraud, but it'll give a cue right there to the agent or send a call to the specialized desk upfront much more efficiently. But this is one that's got some legs in a whole bunch of different areas. But in the meantime, they're piloting with 2 of the 5 largest banks in the country. And frankly, what I really love about this is, if you look at the bottom, we led the investment. You see some of the valuations for AI companies. This company, we got in at a convertible note. Actually, this is an equity round. I apologize. We got in an equity round where the company's worth only, $10 million. So we have an awful lot of upside in this one relative to where we entered the marketplace. And we've been very focused on AI because everyone who talks to us says they're an AI company. Everybody. Like it doesn't. They could be making lollipops, and they're going to say they're an AI-driven lollipop company. So we're very specific in how we go after this place, and we're looking for very practical applications of AI because it's very early, right? And ChatGPT is probably going to wipe out a lot of different applications. So we're looking for very specific things that have B2B applications, and we think Vox fits that queue. And again, we just got in at a really great price. If Resilient is trying to help manage care at the entry level with primary care, MedZone is all the way on the other end. So very experienced, exited entrepreneur, relocated from Boston to Palm Beach and building her company there, several exits. And they are helping folks with complex diseases, cancers, other diseases, get into the right treatment plans, make sure they can get access to the right drugs, make sure they're in the right clinical trial programs, make sure they're concierge throughout that process. So this is a very small population, but drives close to 40% of healthcare costs for payers and employers. And so there needs to be a different medical management system around these folks. And MedZone has built the platform to be able to do that with a very deep experienced team. They will likely go to Series A early next year as well. They're making some really strong traction out of the block. And as I said, have a very experienced team behind them, which we love. These are, in general, our entrepreneurs are not, on their first rodeo, just kids doing stuff out of a garage. Not that wonderful ideas don't come out of that. There's been a lot of them. But, having some experience and knowing how to build these companies is certainly a value add from our perspective. Mavi is another Florida-based company. Also, again, another female experienced entrepreneur. My guess is most of you have cars that have in-dash, rather sophisticated systems, but not as sophisticated as Apple Play or Google Play. That really is about to change. The car companies have recognized that they've not done a good job with their integrated systems, and they're losing dollars and mind share and data from their customers by not having that. So as they are upgrading their systems and the screens are getting bigger in cars, they want the ability to conduct direct commerce where you can actually use the GPS to say, where are the 5 restaurants near me, not have to go to Uber Eats or something else, but right then and there, place an order and have it waiting for you when you get there and get driving directions to it. That's the piece that Mavi does. They enable the e-commerce from a restaurant and a retail perspective. They came out of a very strong accelerator program called Plug and Play, which basically matches large corporations to entrepreneurial companies to help solve problems. So she already has contracts with Audi, with Stellantis, with BMW, with Volkswagen, and over the next year, through the software partners that are building the platform, we'll be rolling this out to thousands and thousands of cars. In case you're wondering, the government piece here is data privacy regulations around what that data can be used for, and also safety issues, right? Because you get into distracted driver legislation. So we want to make sure that systems like cars can be used safely in cars. Our last one is a company called Mars Suite. It's a cybersecurity platform that was originally designed for NASA and is now being rolled out commercially. Beyond the cyber solution, what is unique about this is how it came to us and some of the connectivity and proprietary deal flow that we have. So one of our larger LPs and one of our strategic advisors runs a logistical company tied to the military, technology and logistical outsourcing support. He's part of a defense program called the Mentor Protege program, where his company basically mentors and helps drive connectivity with the defense and military for innovative early stage companies. And so he kind of incubates these companies for a couple of years. And for the ones that have the opportunity to be spun out, raise capital, and commercialize beyond that, our agreement with our partner there, who has his own venture fund, is we have right of first refusal on investing and co-investing. And this was the first of those companies that we invested in. So it's a great way to get an early look at some of these early companies before you have to make a commitment on capital. That's it. I think, our bios, as Joe said, please go in and read them. I think we went through all them. The other thing I will mention, we do have a fourth partner, which is an entity. It's a group called 1858 Capital, which is based here up in Orlando, where I live. They are a mid-market M&A firm. But what they provide to us is a pretty robust back office that helps us with valuation support, due diligence, LP communication, probably more than you would get at a venture fund of our stage and size. So they're a real strong asset to us in terms of our ability to do the things we're doing from an investment standpoint, but also to support our LPs.
Good stuff, Rob.
So
Brian,
yeah, Joe, with that, I'll
really
turn it
good
over to
stuff.
you and certainly answer any questions anyone has.
Yeah, really good stuff. It was a pretty interesting lineup of companies, and the thing that struck me took me back to something you said earlier, that regulation is just a fact, and whether you think that government money is providing necessary kindling, as it did in the space program or with telecom or with the internet, or whether it's trying, however clumsily it sometimes does, to pick winners and interferes in markets, there's always these demands for new technologies by the companies in the market and by the government itself. So no matter what happens, no matter how it rolls, no matter who's grabbed the wheel for 4 years or 8 years or whatever, there's always going to be these opportunities. I'm interested in how do you source prospective ventures? What are your no goes?
Yeah. So we source them a couple of ways. One, as I mentioned before, we have a lot of connectivity, certainly, to our home backyard. So there, at this point, I'm on the board of the Florida Venture Forum. I'm tied with UCF. Jonathan is well connected in Miami. Obviously, there's all of our government ties. So certainly anything that's happening in our backyard here, we're gonna know about it. And because we lead rounds, we're also very attractive stopping points for entrepreneurs, because in many cases, they'll be able to talk to people who will say they'll add on, but they need a lead. So as our reputation has grown very, very quickly and our natural connectivity, that's really helped. Our LPs, frankly, are also folks, a lot of them have their own family offices and are looking at investments all the time. And so sometimes they're looking for us maybe to help validate what they're thinking from a family office, or potentially to co-invest. Funny story, our co-investor at Kind Designs is a group called M4 Investing in Tampa. Really great family office. They ultimately decided, after seeing because they were originally going to lead the round, and then it was clear they needed someone else to come in. And so, we came in a little bit later and recrafted the deal. Just because we'd had a little more experience in that type of investing than they do. They're they're experts in some other areas. They came in and then made an investment directly in the fund at the same time they invested in Kind. So we get a lot of things through our LPs, who are just, again, really connected. Several of our LPs are ex congressmen and ex state senators, or ex CEOs of companies, and so we get a lot through that. Brian sees a lot of interesting deal flow up in New York from a healthcare perspective, given his perch at Northwell. We're very active on, building our own brand in social media, and because we have a niche, people find us. And then I think, and then Jonathan's firm, Jonathan still runs Converge. And as these innovative technology companies are coming to him for regulatory support, not all of them, but some of them need capital as well. And they become another pipeline for us as well. So I never like to say, we have this solely unique proprietary deal flow, but we do see some things, if perhaps at the very least earlier than some other folks, or through a different lens or through a different door than somebody else, which has been helpful to us.
Yeah, I mean, staying involved, that makes sense. If you look at Rob's bio, everyone, you'll see his involvement in all of this. And all the guys are involved in this in some way, shape, or form.
Yeah, it's certainly not just me. It's the whole group.
Yeah, the whole group. And being involved at that level, and that, I think Rob's term was the ecosphere for venture in Central Florida, or where the other guys are located. That's just key. That makes sense. What is there anything you're avoiding?
Yeah. So the big one we do not like the FDA. So no drugs, no medical devices.
Interesting.
And I'll tell you why. It's a little too binary. So it either happens or it doesn't. Brian, Jonathan, and I prefer, okay, if plan A doesn't work, let's go figure out if there's a plan B. Or sometimes there's no plan B for these companies. There's also a very long, there's a long pipeline for these things. There's a long timeline. And look, there are folks that specialize in that and have that expertise. And I think we would admit, for our regulatory expertise is not at the FDA. So better to not do it. Stay away from it, because it's not for the faint of heart. So that's one we don't do. And then others, it changes over time. The things we're looking at right now, if there's a change at the administration next year, some of those things may change, right? And we'll be looking for that.
Not to give away your secret sauce, or let us know where you're bird dogging, but other areas that you're looking at that maybe not just quite ready yet, anything like that?
Well, again, the AI one is one we have to keep our eye on, right? I mean, it's interesting. It's on the beat of,
it's this decade's nano. So
yeah, but what's the challenge is, Joe, again, you've got this sort of regulatory cloud over it, and then you've also got, for all the hype, the B2B adoption at a major level has not happened yet. It really hasn't. There's a lot of skunkworks things going on. There's a lot of us are on ChatGPT, and we're paying $20 a month for ChatGPT. Right. But enterprise AI, where you're replacing large swaths of people, it's really early. You're seeing some of it, but it's not quite there yet. So we're treading lightly, because, go back to the early days of the internet and think of all the internet service providers that were super hot and great companies and don't exist anymore. Absolutely. Let's start with AOL, right? I mean, Netscape. I mean, there's so many of those companies. So, so we're obviously, from a macro standpoint, there's no doubt it is going to change. But where it changes and how it changes, particularly from an investment standpoint, so we're careful not to be caught in the hype. I will tell you, in that space, something where there's an eighth investment that we're looking at, which is more in the infrastructure space on the data center side. Because the drain, I mean, there's just an article a day, or a CNBC piece. It was a great one in the Wall Street Journal about the billions that Amazon is about to spend in their data centers, because the data centers are not equipped, nor is the electrical grid equipped to handle what AI needs. Plus autonomous, electric vehicles and all those other things. The drain on the electric grid and data centers is pretty real, and I think people are not really understanding where that is. So that's a space we're really interested in, and there's a couple of unique opportunities that we're looking at, again, in our backyard, that we have the ability to be able to potentially invest in. I'll tell you another one that we stay away from. A lot of the online gaming, a lot of the online gambling, highly regulated, but very Byzantine. What Tennessee's doing is different than what Florida's doing, and this state and that state. And there's a couple of really big prominent players in there with a lot of money behind them. So, again, part of what we should do as investment managers here is really assess some of those, assess where some of those risks are, and
Right, and I
just
would
because
say,
they're a
Rob, too,
regulated
that
industry doesn't mean we have to invest in them.
right, I would say general just vice businesses in general, right, are probably unlikely for Govo to invest in. I also think that's probably in line with our fifth partner there, Tim Tebow, too, as well, right, in the way that he's thinking about the world.
Yeah,
Yeah.
that's and for IRA investors, that's pretty much the case as well. That's great. That adds a little bit of an extra dimension or two to your investment thesis and how you guys pursue business. We're coming up on the top of the hour. I think we've exhausted the questions. Any closing remarks? Anything you'd like to add to it? I think it's very exciting what you presented. By the way, the self-directed investors listening, you know what to do if you're interested in this. Contact the guys. If you've invested in funds before, it's a fairly simple process. You log on, you get the paper, you execute the docs with the guys after doing your due diligence, and then you upload the docs to the asset purchase directive, and you're in. So
Yeah, the only thing I'd say is, again, yeah, thank you for your time. I know there'll be a lot of folks watch this on video as well. I know it's a holiday week. We sort of I know we had to get this in now just because of when we're closing.
yeah,
My email address is pretty easy to find. It's rob@govovp.com. Feel free to reach out with any questions, or if anyone needs a deeper dive than we gave here. I'm happy to do it, or certainly share follow-up materials or documents with anybody.
right. And one of the things that, I don't know whether we'll give you the list and, you'll be able to communicate with folks directly, but yeah, we do
Wonderful.
urge you to get in touch, ask any questions. Guys, thanks so much. This is a big value add for us, because being able to provide our audience with additional information about new investments, they're always looking for something new. And you gave them a good glimpse into something that I know, I hadn't seen before. So thanks a lot.
Thank you, Joe. Have a great Fourth, everybody.
Thank you.
Oh, by the way, yeah, and we expect
You guys.
we expect an update at some point. So maybe you come back at the end of the year, early next year.
You
and tell
got
us
it.
what you're up
Happy to.
Okay. All right, guys. Have a great weekend.
Thanks, everyone.
Thank you,
Bye-bye.
guys.
Bye-bye.
Bye.